Today I'm going to share with you one of the most powerful lessons I've ever learned in all of trading, and it was shared to me by a floor trader in Chicago. So here we go. Let's get down on it as cool as the gang said. So the key concept is this. We want to stay into a market move that has strength, but we don't want to get out when weakness occurs. So it answers a basic question. That question is this: Barry, how long should I stay into a move? How do I know when to get out? I don't want to get out too soon because I want to make the big money. I want a good risk-reward ratio. And this is a big problem a lot of traders have, is they get out too soon. So how do we avoid getting out too soon? Here's the solution. So the basic premise, first of all, in fact, let me just bring up a little handy-dandy drawing tool here to show you. So I'll just use the white space here. First of all, I'll give you the basic premise. So what he said was you want strength. We're going up. You want strength up. And then if we're bullish, and then weakness down. Strength up, weakness down. Strength up, weakness down. As long as we have that, then we want to stay into the trade. Now, what does it mean, strength up, weakness down? It has to do with the money flow. So you could think of it as basic supply demand. So we've got a lot of demand coming in. When the strength is literally the money behind the move. We can stay in this trade, in other words, don't get out too soon, as long as the retrace is weak. And what's going to be happening behind the scenes here is there's going to be some profit taking here from the whales, from the big players. And they don't want it to keep going up too far. They want it to settle back down so that they can come back in and then buy at a lower price. They're always wanting to buy at lower prices. So they will stop buying in order for the retrace to happen and then to keep getting in on these lows. Now, another dynamics that happening, though, is on the other side. And this is the retail traders, the amateur traders. And oh my gosh, I can't even tell you how many times I've seen this. They are shorting this. So they're shorting that high. They're shorting that high. They're shorting that high. And so that causes the retrace as well. That's the other aspect here that is behind the scenes causing the retrace. So you're getting orders coming in that are short, but these are lightweight orders. And that's why it's weakness, because it's not very many shares, not many contracts, not many lots, depending on what market you're trading. And I've sat in chat rooms. Let me tell you this. I have sat in chat rooms and I've listened as retail traders are commenting back and forth at Discord. Sometimes it's writing, sometimes it's audio, whatever. And I can't tell you how many times I have heard people say, oh, I'm going short here. The market can't go up any further. Whoops. And then what happens? They go short, the market goes back up, takes them out, and they're like, oh, dang, I can't believe that happened. They say, okay. Well, now it's really overbought. Can't tell you how many times they've used that term, overbought. And so now maybe they're using some kind of oscillator, RSI, stochastic, whatever. And they say, oh, the indicator says overbought. And so then they short here. And they say, oh, market can't go up anymore. So they short here. And then what happens? Of course, as you can see, market goes up, takes out their stops, and takes them out again. And then a common thing that they'll say is, oh, this market is crazy. This market makes no sense. I'm done. I'm going to play golf or tennis or play a video game or whatever. What they don't understand is the market's making perfect sense. And this is why it's so important to understand the market logic behind these patterns. So they're constantly trading against the dominant energy of the market. So one of the sayings that I have in Top Dog Trading, one of the core principles of Top Dog Trading is to always and only trade in the direction of the dominant energy of the market. So again, let's clean this up here a little bit now. Start fresh. And now let's look at this actual example going short. So I like to always use long and short examples. So here we have strength down. Okay, now weakness up. Now, what's interesting about weakness up is sometimes it's not just a single move like this. Sometimes it can be going sideways, and that's still weakness. So in other words, there's no strength. There's no major buying coming in. And so we've got strength down and then weakness in the market. And then boom, strength back down and then a weak retrace up. And then another strong move down. Okay, now when you look at this, so this is trading in the direction of the dominant energy of the market. The dominant energy of the market is down. Now, once we look at this retrace, if we stopped here, that would have been weakness up. But it didn't stop there. It went all the way back up to here, which is this high. So now we have strength down, weakness up, strength down, strength up. So now we no longer want to be in that trade. Let me show you a way. Now, you might look at that and say, yeah, but isn't that too late to get out? And you're right, it is too late to get out. So what do? We want to use a tool, a mathematical tool, so we don't get out that late. Let me show you what I like to use. So what I'm using is I'm using the 50 SMA. Let me get my little drawing tool up here. So this is my 50-period simple moving average right here. So that's a lagging indicator, but this is telling me, okay, we've got, market's moving down over the last 50 bars. It's moving down on average. But this black line here, that's my 15 exponential moving average. So that's a much faster moving average. And that's the line on the sand that I'm going to use for weak retraces in a downtrend. So we break the 15 EMA here. And what I want to make sure is that every time we retrace, we basically hold it. We do not go above it. So that means strength down, weakness up. Strength down, weakness up. Now we get into this sideways movement. Okay, but it's still basically holding the 15 EMA. You may look at these highs and say, well, the highs are above the 15 EMA. That's true. But all these bars are basically touching the 15 EMA, so they're right in that zone. And then it goes back below and down, so strength down again. So now we continue our downtrend, strength down, weakness up, again holding the 15 EMA, strength down, making a lower low. Now, again, we don't want to wait until it puts in a higher high or an equal high. And so once it breaks above the 15 EMA, well, then it's no longer weakness moving up. Now it's strength moving up. So that's the line in the sand. Now, one more thing that you need to apply here is, so this gives you the lines in the sand, but it's still not super precise like we looked at with a 15 EMA here. A little bit above it, and it just kind of is touching these areas. So, and here even it gets a little bit above it, but which bar do you want to enter? So if you're going to go short here, or even go short back here, which bar do you want to enter? Look at that, 1, 2, 3, 4 bars. Which one of these do you want to enter on? Here, which one of these? So I'm going to give you my cycle indicator. This is my market timing indicator. And it will show you to the bar, to the penny, to the pip, to the tick, exactly where I enter my trades. It's super precise. This is my scalpel tool, if you will, in my toolbox for trading. So you can get that at indicatorwebinar.com. There's a recorded webinar there, absolutely free. I'll show you how to set it up on your charts and how to trade it.